My name's Nate Zeller. I'm the Chief Investment Strategist here at Secured Retirement. Many of you have met before, and it's good to see your smiling faces. Many of you have met before. It's been a real pleasure. My intent today was to talk about the markets and kind of what we're looking at for the year ahead. I started putting this together a couple weeks ago. Unfortunately, things have changed lately, so we're going to touch a little bit on kind of current events a little bit, then talk about what we see going forward. So let's get into it, and feel free if any of you have questions, don't hesitate to stop and ask, and there's time for Q&A at the end. We do have to start with our regular disclaimers that the lawyers make us talk about. A lot of what I'm talking about today is an outlook, so it's a guess as to what we think going forward. Don't take it as individual investment advice. If you do want to talk about your individual investments, please give us a call. We'll sit down with you on a one-on-one basis and talk through it. So our agenda is I briefly want to touch on the 2021, just a real quick recap. It's in the past. A lot of you know what happened, but we'll touch on it and kind of set it up to what we think is going to happen going forward. I do want to talk about year-to-date, what's happened, and then our outlook and predictions. Making predictions is difficult. I'm putting this in print. This is being recorded and saved, so you all can look back at this in a year and say, this guy doesn't know what he's talking about. It was all wrong. So I'm going to, kind of mention that there's a lot that can happen between now and then. Markets, economy, geopolitical, that will obviously affect this. I'm sure, if we do this at middle of the year, our thoughts are probably going to be different by then. And since I started to put some of this stuff together, obviously the world's changed a little bit too. But I think it's good to throw out some ideas as to what we think is going to happen, just to give you all an idea of where we see things, at least currently. So a real quick recap from last year. This is the asset classes. I have a lot of charts and graphs today, and a lot of these don't get too hung up on. There's one towards the end that's important. The rest of these I'll talk through, especially for the people watching online. Asset class 2021 performance, Bitcoin did really well. Bitcoin today is not doing so well, and that's probably the last thing I'm going to say about that. We are looking to do a quick market huddle on Bitcoin here in a couple of weeks where I'll talk about it some more. All cryptocurrency. Oil had a very good year. Commodities had a very good year, driven primarily by the energy, oils, and a lot of the industrial metals. The S&P 500 returned about 27%. The Russell 2000, the small caps, were higher by almost 14%. The MSCI EFA was higher. That's the foreign stocks, developed foreign, so your Western Europe, Japan, Australia. That was higher by about 8%. Bonds lost money last year. That's after interest, after income and yield. The reason for that is we'll talk about this more in a minute too, the inverse relationship between yields and prices, and bond yields went higher, so bond prices went lower. Gold lost money. I really want to circle this a lot. I get a lot of calls. People are like, gold is the perfect inflation hedge. No, it's not. And this proves that there was a lot of inflation last year. Gold did not do well. It's currently not doing well. And there's a number of reasons for that. One of which is that with inflation, the dollar tends to strengthen the U.S. dollar, and so that puts pressure on gold prices. Emerging markets were lower by about 5.5%. It's surprising given that the rest of the markets were higher. The emerging markets were hit real hard by coronavirus, and they really didn't come out of it quite as well. Not as we're sitting here today talking about Omicron, not that we quite come out of it yet either, but the emerging markets done worse and not recovered. Then silver was down by about 12%. And silver is more of an industrial metal versus gold, so we're not going to get into it too much, but I think silver probably has a better outlook than gold if any of you are looking to buy metals. Looking at the sectors real quick too, energy had a great year. It was up about 48%. We've all seen that, paying at the pump. Natural gas prices really spiked a few months ago, and they've since come down quite a bit. A lot of that had to do with geopolitical events in Europe. Financials. The bottom line is really every S&P sector did pretty well last year. Double-digit returns. Sun did extremely well. Energy did very poorly in, 2020, if y'all remember, coming out of coronavirus, COVID. So this is a rebound. Real estate did quite well. Technology continued to do well. So that's a quick recap. Now I've a quick question here. These are 3 stocks in the automotive industry, and I cut off a lot of stuff. I don't necessarily need a show of hands, but anybody in here wish that they'd owned Tesla a year ago? Seeing a lot of hands. Tesla's a good stock. It actually returned about 800% in 2020. 2021, it returned about 50%, which is good. It doubled the market. However, Ford Motor Company did about 135% last year, and boring old Goodyear Tire and Rubber did 95%. The reason I show this to you is Tesla grabs the headlines, and everybody out there says, you oughta own this, you oughta own that. There's these other old economy companies that are doing just fine. So it's just, again, it's awareness that don't follow the headlines, don't follow everything you see on TV. And again, Tesla did great. Yeah, I doubled the market, so there's nothing wrong with owning it, but there's other things that did just fine too. For those of you that were here when I did my quarter 3 recap, quarter 4 outlook, I've stolen a lot of the slides. The reason for that is I want to look back and see what's happened. And this is one of the slides that I used then. There was an increase in COVID cases in quarter 3. I just scratched that out. Now it's Omicron. Sigma next. I don't know my Greek alphabet that well, but where does this go? My thought is that COVID gets to be more of an endemic, especially here in developed countries. The analogy I always use, it's like a bouncy ball or a basketball where you bounce it and it bounces higher, then it loses energy as it goes and it gets weaker and weaker, and that's kind of what we're seeing here with the variants. I'm not an expert or a medical expert or a doctor or an epidemiologist by any means. So it's just my guess is what's going to happen, but Omicron did play a part in the markets in quarter 4. Interest rates, we expected them to rise. In quarter 4, interest rates were fairly flat, especially when you look at a 10-year. The 2-year and the 5-year, the shorter term stuff did move up a little bit. Now in 2022, it's a different story, but in 2020, or quarter 4 of 2021, they really didn't move a whole lot. Fed action, and this is a big thing that we're going to talk about more in a minute, and it's not that the Fed did a lot in quarter 4, they talked about it, and that's enough to move markets. Political wrangling, we'll talk about politics a little bit. Politics don't always move the market, but if you think back, there's a lot of the debate on the Build Back Better plan and everything going to the debt ceiling. There was a lot that kind of weighed on the markets a little bit, but by the end of the year, it was pretty much over and taken care of. Stock price valuations, and this is a big one. If I had a big red pen, I would circle. This has been a concern. We're going to talk about this much more in about 15 seconds here. It weighed on the markets, but the markets shrugged that off. And then the Chinese real estate. And I put this in gray because in the middle of November, everybody was freaked out about what impact this might have. And the Chinese real estate market is not doing well, but it's not had a contagion effect. It really hasn't affected other parts of the economy outside of China. There's very few U.S. financial institutions, banks that have any exposure. So at the time, everybody thought that was going to have this huge 2007, 2008 type impact, and it really didn't worldwide. Now it is affecting the Chinese markets. But 2022 so far is like a roller coaster. And you notice this is roller coaster. It's just gone down, not coming back up or doing any corkscrews. I did this slide a couple of days ago, and it's worse now. The market's down about 3% today. When I calculated it, the S&P 500 is down about 12% off of its 52-week highs, which puts it into what they call correction territory. Correction would be down 10% or more. A bear market's when it's down 20% or more. The Nasdaq's off by about 11, was off by about 11.5. That's 15 or 16% now. The Russell 2000, which is a small cap index, is actually off of its highs. Now its highs were reached back in November by about 21 or 22%. So that technically is in a bear market. As of an hour and a half ago, I don't know. I'm crossing my fingers hoping the market just rebounds, but I'm guessing it has not. So what has happened, a lot of it comes down to anticipated action from the Federal Reserve. The Federal Reserve's expected, they are tapering their bond buying program. So previously, coming out of the pandemic, they were buying $120 billion worth of bonds in the market every month and adding to their balance sheet. They said, okay, we've done enough of that, so instead of quitting all at once because it could have a pretty big impact on the market, they're going to what they call taper. So that means slowly reduce. So instead of buying 120, they might buy 100. When they first announced this, they said they were going to do it over 6 months. Now they've started to speed it up a little bit because inflation's running so hot. They don't like pumping that extra money into the economy. So they're expected to really wrap it up by March, if not sooner. There is a Fed meeting this week, and they could come out and say, yeah, we're done. We're not buying any more bonds. And then with that, rising interest rates have come up quite a bit in 2022 since the beginning of the year. They have pulled back the last few days, and we'll talk more about interest rates a little bit later. But then the big one is stock valuations. For anybody paying attention to the market, stock valuations have gotten crazy. They're not 2000 crazy. You see a lot of these companies with, well, let's see here. Oh, we'll talk more about stock valuations in a minute. My slides aren't in the order I thought they were, which is doing. Some not so fun facts is and again, this is from last week, so it's obviously gotten worse. If you look at the NASDAQ, which is generally technology stocks, it was more than 40%. I'm guessing we're closing in at 50% now. Those listed stocks are 50% off of their all-time or 52-week highs. Since the all-time highs were generally hit within the last 52 weeks, and then more than 20% of the stocks in the S&P 500 are now 20% or more below. I'm guessing that number has come up quite a bit too. We're looking at probably 30 or 40% even. So even though the major indices aren't necessarily in a bear market, a lot of the individual stocks are. It's kind of an under the surface bear market that's going on right now, which is important for the stocks that you own and buy. So stock valuation, and this is a real quick one. Is people talk about price to earnings. Real simple calculation. It's the stock price divided by the earnings per share that the company announces on a quarter basis. Generally, the price to earnings is what they call trailing, so it's looking backward over the past year. The problem with that coming out of the pandemic is earnings were so just all over the place. You know, they weren't consistent, so they're quoting these price to earnings looking back, and it's probably not a real fair representation of what was really going on. And it's not the only thing that should be looked at when deciding what stocks to buy, what's cheap and what's expensive, but it is one indication of how stocks, especially in the same sector, are trading, you know, relatively to each other as far as price and valuations. Just to give you an idea, also there's something called forward PE, which is looking out at estimates for the next year and where is the stock price trading compared to where the estimates are for earnings per share. The long-term average for the S&P 500, we'll call it 17. You look at a number of sources and it's anywhere from 16 to 18. We'll call it mid to high teens. Since 1980, it's come up. Since 1990, it's come up too. You know, the price to earnings have kept getting higher, which isn't necessarily bad. It just shows what's happening with the market. A lot of it has to do with the emergence of the technology stocks. Any stock price is based upon expected future earnings. A lot of tech companies don't have a lot of current earnings, but they're expected to make a lot of money down the road. Perfect example of this is Amazon. Amazon didn't have earnings for years and years, but they kept expecting it to. Then when it did start to have earnings, that's when the stock price really took off. That's also what's hurting it right now too, is it's discounting cash flows. And so if you have cash, this is like opposite of a loan. So with a loan you pay interest, so the dollar today is worth probably less than, or more than $1 down the road. And if you look at a stock price that's discounting their future earnings, if the interest rate is higher, those future earnings are worth less today. That's why a lot of the growth stocks are getting beat up in the way that they are with anticipation of Fed action and higher interest rates. So again, this is as of last week. The trailing price to earnings, which is probably a little skewed still coming out of the pandemic, was at about 25, depending where you looked. I saw numbers from 23 to 27. After today's sell-off, I'm sure that's come down a little bit. The forward PE is about 20 to 21. The forward PE over the last 25 years has averaged 17 or 18. It's generally a little bit lower than the trailing because earnings are growing looking forward versus looking backward. A quick fun fact is the highest trailing PE ever recorded for the S&P 500 was 123 back in May of 2009. And remember, the average is in the high teens. And so the reason I mentioned this is you listen to a lot of analysts and they say, hey, this stock is cheap, it's a time to be buying, or this is expensive, you shouldn't be buying. I don't know if anybody in here remembers 2009. We're coming out of the financial crisis. March 2009 is when it hit its bottom. May 2009 would have been a great time to be buying. And again, this is a trailing PE, so it was looking at the earnings looking backwards, and with the financial crisis, earnings were all over the place, just as they have been during the pandemic too. So I point this out for the reason this shouldn't be the only metric you look at, but it's one that's often quoted, and it goes into the whole equation of analyzing stocks and portfolios. One way, so if you have your price to earnings, this sounds like a math lesson, so I apologize if I'm boring anybody here. everybody says, okay, so you have this inflated price to earnings, so what has to happen? There's two equations, so the numerator is the price and the denominator is the earnings. And if I got those flipped, I apologize to my 8th grade math teacher, because I don't know, probably 4th grade, because I don't know fractions. So either what has to happen is your price has to come down or your earnings have to go up. And this is an example of that. This is a company called Alphabet, or I call it Google still. I can't seem to wrap my head around the new name. The green line here represents its stock price last year. The mega cap, the big technology stocks, Microsoft, Amazon, Google, Facebook had just outstanding years. Alphabet happened to be the best of the bunch. It returned about 65% last year. What happened is its earnings grew faster than its stock price. So its price to earnings, which is the blue line here, and this is December 31st, December 31st, or January 1st, December 31st, 2021. So its price to earnings started the year, we'll call it 28, 29, and ended the year at about 25. So even though the stock price went up 65%, its price to earnings was lower at the end of the year than it was the beginning of the year. The reason I show you this is stock prices don't necessarily have to fall in order for the price to earnings to come more in line with long-term averages. I think that's it for the math lesson today. Again, these are some predictions. Some of these I came up with and may not even be valid already. I think the stock market's going to have a positive year this year. I think we're going to shake things off. If you think about it, if this prediction is correct, we're already lower by, we'll call it 10%. And so from here to the end of the year, it's going to be a halfway decent return. I just don't think that it's going to be as good of a year this year as it has been the last couple of years. And I'm not alone. A lot of the analysts you listen to think, mid to high single-digit returns. The long-term average is for the S&P 500 on an annual basis, 9 or 10%. You can see the last few years, minus 2018, have been very high, so more of a reversion to the norm, or the average. Earnings are expected to continue to grow, but probably at a slower pace. Earnings grew at 45% last year of the S&P 500 compared to the year before. Again, the year before was the pandemic, so the 45% is a little inflated. Most analyst estimates are looking at 8 or 9% earnings growth this year. And then the valuations and earnings. If you look at these stocks that are getting beat up, it's a lot of companies without earnings. This is back to the dot-com bust, where any company would put a dot-com at the end of their name. They wouldn't make anything, they wouldn't have any earnings, and they got punished for it, and a lot of them went out of business. Now we're seeing a lot of technology companies, they actually produce something, but they don't have positive earnings, but their stock prices just took off, again, in anticipation of future earnings. That it seems like the market got a little ahead of itself. So now these companies with decent, strong, steady earnings are the ones that have held up best in this market and probably will for the rest of the year. Speaking of predictions, value I think will outperform growth. I mentioned some of the PEs here. If you look at where they are priced in the market, value just looks a lot cheaper than growth. Also, value sectors tend to do better in a rising rate environment, historically speaking. I think small cap's going to outperform large cap. This is looking at today, I mentioned the Russell 2000s in a bear market currently, so it has a lot of ground to make up. But if you look at small cap value, of all the different types, it's value and growth stocks, small cap, large cap. Small cap value is the one that's most reasonably priced. They're also the ones that are probably least sensitive to interest rate hikes. Conversely, small cap growth are those that are probably most sensitive to interest rate hikes. They carry a lot of debt sometimes, and they don't have positive earnings. And then if we're looking at individual sectors, I'm looking, again, a lot of inflation this year. So you look at those sectors that do well in an inflationary environment, which are energy, materials, real estate, like we saw last year. That probably won't change. Financials, when interest rates go up, they have their net interest margin. These big banks, they can expand that and make more money, so financials will probably do well. Industrials tend to do all right in an inflationary environment, as do consumer staples. So consumer staples are those things that food. Kraft, for example, is a consumer staple company. Campbell's Soup. It's those that can pass on the increases in pricing to their customers. Not all companies can do that. But everybody needs food compared to consumer discretionary, which are the stocks, the companies that you don't have to go buy. I mean, you need to eat, but you don't have to go to Olive Garden to eat, or Ruth's Chris Steakhouse. So I use Olive Garden. That's my house favorite. That's my kid's idea of a really nice night eating out. So we're going to go with it. That's more of a discretionary. versus the staples that are things that you have to eat. And when times get tough, if you go back to 2001, after the attacks, 9/11 attacks, Campbell's soup was the only stock that traded higher the day the markets opened up after 2001 attacks, because everybody was worried that the world was coming to an end and we're going to all be eating soup. That's a very extreme example. Real quick, this is a very cheap shot, and I almost feel ashamed saying it. Don't watch TV. This is a famous commentator on TV back in January, said buy Netflix. And if you look at it from the time he said it, they came out with earnings last week that were horrible. It's down another 10% today. And Netflix is fine. We have Netflix at my house. I don't watch it much, but the stock was already down quite a bit. So some of these commentators on TV, they're for entertainment purposes only. I tend to get a call all the time. Well, Jim Cramer said to buy this or that. Yeah, I'm sure he did. Getting back to kind of how we see the economy looking forward. When I go back a quarter ago, and that's really what the previous arrows mean. If it's red, or green, it means things are going up at a nice pace, and it's things that we want to see going up. Currently, some of our forecasts have changed. It's where you see the arrows starting to tilt. They're not upside down, meaning a deceleration or a decrease, but not as much. So GDP growth this year, we're expecting to be, the overall economy should grow, but not as fast as it did last year. Retail sales, probably not as strong as they were last year. People are worried about inflation, so they're not out spending as much money as they were. Consumer confidence is being hurt by inflation a little bit too. It's still strong. The consumer makes up, and retail sales make up 70% of GDP. So if that stays strong, the rest of the economy, it should push the rest of the economy. It'll probably slow down, but not fall off at this point. It doesn't look like it's going to completely fall apart. People are still going to Target. They're still going to Costco, spending money. The job situation seems to have deteriorated a little bit. Wages have gotten quite a bit higher. That's an input cost. That's causing more inflation and making things more expensive. And then inflation, you can see I made that arrow even fatter because inflation's running really hot, as I'm sure you're all aware right now. I don't get out that often, but I was at a store this weekend, and I'm like, there's no way this costs this much. And yeah, it does now. Speaking of inflation, yeah, the latest numbers, 7% year over year, that's very high. Long-term averages going back to the beginning of time are more in the 2 to 3% range. The last 10 or 15 years, we've been hovering around 0.1, maybe 2% a year. The producer inflation measured by the PPI wholesale, so that's all the raw materials type things that go in and then is eventually passed along to the consumer, was higher by almost 10% on a year-over-year basis last month. Our guess is that inflation will remain elevated, but probably stabilize more in the 3, 4, maybe 5% range as the year continues. There's a lot of supply chain issues. Like I mentioned, labor costs have come up quite a bit too. This is a chart, and this chart isn't real expensive or real easy to see. So this goes back, I think I went back 7 years, and the blue line is an increase in wages year over year. And you can see up prior to COVID where wages went up 2-3% a year. It's pretty normal, kind of in line with inflation, maybe a little bit higher. Right now they're higher by about 5-6%, but this looks at what we call real inflation, or real wages, which is the nominal wage growth minus the inflation rate. And so real wages are down 2%. That means that you could have gotten a raise at your work, about 5%, but with the effects of inflation, you've actually lost 2% of your spending power. I mentioned that most of you here are retired or near retirement, and so that has an impact, and certainly something to think about. When you're looking at returns for the next few years, whether it's stock market, bond market, whatever, you want to make sure that what you're getting is keeping up with inflation. You're not eroding your purchasing power. As far as the Fed, we anticipate them to end their monthly bond buying program in Q1, which should be March. There is a meeting this week. We'll probably get a little more clarification. What the Fed's talking about doing is going the other way. So this bond buying program they called quantitative easing because it was pumping money into the markets and the economy by buying bonds. They're now looking at quantitative tightening, which is they have this huge balance sheet. So they own all these bonds that they now need to get rid of. They can wait until they mature, or what they can do is sell them in the market, sucking liquidity out. They're talking about a quantitative tightening later on this year where they're going to start to sell some of these bonds, reduce their balance sheet, which, as it takes money out of the system, should help with inflation. They're forecasted to do interest rate hike in March. They could come out this week and say they're going to hike rates. The current forecast, so looks like March is more likely, 0.25%. There is some speculation they could do 0.5%. There's forecasts all over the board. You know, we go back to September, and most people said the Fed's not going to raise rates till 2023. And a few people said, well, maybe they will once or twice in 2022. Now the consensus is at least 3, if not 4 times. Some people are even saying 7 times this year. Some are saying as low as 2 or 3. I'm guessing it's probably 3 to 4. Probably quarter rate hikes every time they meet. And it takes some time for these to work through the system. And they don't want to disrupt anything, especially in an election year. So they're probably going to be very slow and deliberate with it to make sure they don't really hurt the economy, because that's hard to come back and correct very quickly. I had something else with the Fed. I don't remember what it was. So speaking of bond prices and yields, again, I've used this slide before. I think I could find a better teeter-totter, but I think this gets the point. Bond yields and bond prices are inverse relationship. As yields go up, bond prices go down, and we've seen that with the market this year, 2022 so far, because interest rates have gone up, and so bond prices have come down. If you had money in bonds from the beginning of the year, you've actually lost money this year. And so this is what's referred to as the yield curve. Don't get too fixated on this. I just use this as a demonstration. The yield curve points out where rates are of varying maturities, 30 years down to 1 month. The yellow line is a year ago. What the blue and green line up here is now and a week ago, and it's pretty much the same. There's a lot of economists that follow the yield curve as it gives clues about the economy. If the yield curve is steep, as it was a year ago, it implies growth. If it starts to flatten out, it implies slower growth or possibly even recession. And we are seeing a bit of a flattening. The thing about bonds, especially Treasury bonds, is they're trying to anticipate inflation out into the future. And what we've seen down here is that short-term interest rates have come up quite a bit, implying that they expect there to be a lot of inflation over the short-term next couple of years, but not so much inflation, once you get a little further out, 10 years and beyond. So the market's not pricing in inflation on a long-term basis. Of all the charts I'm showing today, I think this is the one to take a look at. It's maybe the most interesting. This is, speaking of the yield curve, this is this is the 10-year Treasury minus the 2-year Treasury. So it's, just a measure of the steepness of the yield curve. Every time this relationship dips below 0, so these gray shaded areas are recessions. And if everybody can see this, every time it dips below 0, going back, this goes back to 1980, a few months later there tends to be a recession. So this is a pretty good indication of what's going on in the markets. I always thought that the bond markets know a lot more than any analyst. It really predicts the future. I think that the yield curve, so the spread between the 10-year and the 2-year, you can see it's come down quite a bit. I think by the end of the year it could actually be negative or below 0, which would imply a recession in 2023, possibly. Because we're seeing short-term rates, so the 1-year, 2-year rates move up a lot faster than the 10-year. And as the Fed raises interest rates, it tends to affect the short-term rates, 1-year, 2-year, much more than it does. The 10-year has a very low correlation with what the Fed does in the short-term rates. I don't think that the 10-year rates are going to move up a whole lot more, maybe a little bit. I'd be remiss if I didn't mention politics. Generally, the political posturing doesn't affect the markets a whole lot. If you look back through time, there's been some small blips. We do anticipate a red wave in November congressional elections. That's historically speaking. Generally, when a new party gets elected to power, with an administration, the opposite party does real well in the midterm elections, at least over the last 20 years or so. There's also been a lot of retirements, especially on the Democratic side. It's very easy for incumbents to be reelected. It doesn't matter if they're red, blue states, their district. It's very rare for an incumbent to be voted out of office. So with the number of retirements, that also kind of stacks the odds in the GOP favor. The Senate will probably be a little more evenly divided. That might tip more towards GOP as well, a little more red. If this happens, and it looks like that's going to be the case, it effectively makes the Biden administration a lame duck administration over the next couple of years. I think the Biden administration acknowledges this, especially given their approval ratings right now, so they might try to push some of this stuff through. They've talked about this Build Back Better, that now their next tactic is to split it up into small parts and pass through little bits of it. The reason I mention it is there's the potential for more government spending, which could push inflation, and as well as higher taxes. That's just, again, a lot can happen between now and an election. You look back at some of these presidential elections in the past, and the outcome, if you would have been told the outcome 6 months prior to the election, you would have said, no, there's no way that's going to happen. So, I did want to finish up kind of with some thoughts, going out a little bit further. So a lot of what I've talked about today is, the next few months, rest of 2022, obviously subject to change. Going out a number of years, I think there's going to be continued strength in technology. It just creates more efficiencies in the global economy. We're all so interconnected. You go back 20 years and email and the internet wasn't used, I should say 25 years or so, to the extent that it is today. We're seeing more and more technology. It's getting faster and faster, and I think that'll continue to drive the market, especially worldwide, most likely over coming decades before it slows down. Emerging markets did very poorly last year. I expect them to do better this year as they come out of COVID. I think that they have a lot of room to recover. That's what I was saying last week. Now, things changed today. When I looked this morning with all the geopolitical events, the emerging markets were getting beat up pretty good. Up until the middle of last week, they were actually positive on the year, too, when the domestic markets were negative. But I think long term, there's a lot going on that's positive for the emerging markets. There's very favorable demographics. They have an emerging middle class, younger populations that are, they're moving into cities, they're spending money, they're having discretionary income. You go to places like China and India, where 20 years ago, large parts of their population lived on farms without running water and electricity. Now these people, generally the kids, the younger generations, are moving into cities and getting good, high-paying jobs and spending a lot of money. Obviously, emerging markets, there's a lot of risk with the governments and other things too, but I think longer term, and China has some issues, but India looks very favorable, as an example. I also think that we're going to see normalization of inflation and bond yields, and when I say normalization, I mean this is more normal, not normal what was 4 or 5 years ago, but normal over the past 20 or 30 years. So inflation, instead of being 0 to 2%, will probably be 2 to 3, maybe 4%, and bond yields will probably be close, where I think we'll see things over the next few years. So really, in summary here, I expect modest returns in equity markets this year. It's difficult for me to say this today when the market's down quite a bit, but we're, 3 weeks into January. There's a lot of year left. A lot can happen. I do think, if you remember that one of the first few slides I showed, where all sectors did well last year. I don't think that'll be the case this year. I think some sectors will do much better than others. Valuations and earnings are back in focus. So, looking at individual stocks, you want to buy quality names that have positive earnings. Expect inflation to continue, but to moderate. The 7% hopefully drops down, 3, 4, 5% by the end of the year. Expect more growth, not just in the markets, but in earnings, but positive growth, but a little slower than it has been, and rising bond yields and falling bond prices. So I'd be wary of the bond market. There's a lot of alternatives out there. With that being said, I do have to put in a shameless plug for our market huddle next week. We're going to have Andy Ives, he's a guest, he works with Ed Slott, talking about QCDs, which are qualified charitable distributions coming out of an IRA if you're 70 and a half or older. It's one way to not have to pay taxes on your required minimum distributions. And then, of course, if you have any questions, we're always here. But that's all. It seems like I went very quickly there. I spoke very fast, so are there any questions or comments? Anybody that?
I have one question. Out of overall, people looking at the, all the particulars, the math, how much of actual stock trading is done by programs that are just automatically doing it based on what somebody said, by exchange trading funds, rather than individuals calling their broker and saying, I'd like to buy this particular stock? I mean, is it like 50-50, or are the automatic ones 90% and the individual people only base 10% of the trading?
I don't know the number off the top of my head, but the program trading is a very high volume. We're seeing a lot. The other part of it is the individual people like you and I, we don't move, we're a very small part of it. There's the pension funds, the institutions that really are moving the markets as well. But a lot of it is the program trading that's set, and I think that's why we're seeing such a large pullback today is when the market starts to fall, these trades start to go off and it pushes prices lower. I also think that at some point we're going to bounce, and it's going to happen very quickly. We're going to go the other direction because the program traders will see the markets moving up and they're going to pile in, and that's part of what happened 2 years ago with the pandemic. If you remember, it really fell and then it recovered very quickly. So we're seeing a lot more of that. So the program trading is a very large amount, as are the institutions. One thing about the institutions, so you have your pension plans, 401ks, is they bring in cash all the time and then they're putting it into the market. Over time, this provides a nice tailwind for the markets to keep pushing it up.
So, but really the individual, like, you know, if I say, God, Telstra is a good stock, I want to let them buy it. The effect I'm having is virtually zilch. Whether Telstra is good and it's going to, you know, be the next $1 trillion company or not, if I think it is and I buy it, if the stock price really is going to be affected more by what programs decide to do and the large investment funds. So I'm really trying to guess it. Okay, how are they going to look at this? Not me. You know, how are they going to look at it? And my guesstimate is not based on, you know, mathematics or facts. It's, okay, what's the attitude going to be here? You know, that's going to make or lose me money in the market. It's what I'm thinking of it. I guess that's just kind of scary that really what I think or what all the facts in the world that you're looking at and you can evaluate don't really mean a thing, because it's somebody else's opinion that's going to dictate whether the market goes up or down. You know, whether Telstra goes bankrupt or not, or makes it big, if you guessed right on it, in the long run, it's going to be good. Good for you. But I guess it's just frustrating knowing that, no, all this stuff that I'm learning and thinking, this is really good to know, doesn't really do squat in the short term especially.
But in the long term, it does. And I think that's what we're seeing now is if you look back to last year, there was a lot of this, I hate to call them garbage stocks that didn't have real good earnings, certainly weren't steady, and it was, you know, program traders, you know, they say that Reddit retail push, I don't know how much that actually occurred, and they pushed these things up to astronomical valuations, and now we're seeing it come back down to earth. And if you look over an extended period of time, I think eventually the fundamentals do come into play. And if you're buying a stock based on solid earnings, they have a solid business in place, they do just fine. It's kind of cut out the short-term noise and look at the long term.
That almost gives credence to the fact that when your stock goes down, the stock goes down, and you want to sell it, and your broker says, no, hold it, you're in it for the long term. Makes his advice good, which a lot of people say, no, that's not
right.
necessarily the best thing to do. But if you think the stock is good in the long run, you are best off holding it, regardless of what the short-term bounces up and down are.
Exactly. Yep.
You know, to try and time a stock is a good way to bankruptcy.
Right. Yes.
I have a question about interest rates for next year. What do you think they're going to do? Do you think they'll hit 4% or 5%?
When you say interest rates, mortgage?
30-year mortgages.
30-year mortgages. Easily see 4%. So 30-year mortgage is most closely tied into the 10-year treasury. And 10-year treasury has come up quite a bit this year, and it's not an exact. Last I saw, I don't follow mortgage rates a lot, they're right at about 3%, I think, give or take. I could easily see them hitting 4%. Next year, maybe 5%. The 10-year, those longer-term treasuries, I don't think are going to move as much as the short-term rates. And the short-term rates, when you hear about the Fed raising rates, that doesn't have much of an impact on mortgage rates. So that's my guess. But with inflation, it's hot, and if inflation is sustained, we get 6 to 8 months down the road and we're still running 6 or 7%, I think we'll see interest rates pop up quite a bit.
My personal belief is that until interest rates hit about 6% on a 30-year mortgage, real estate's going to be a silly. I mean, real estate's not structured right until interest rates are above or about 6%.
I very much agree with that.
People make rational decisions right now. When it's 0% interest, they don't make rational decisions.
No, it's when they start to speculate.
Yeah, right.
And if you look too, people are like, hey, I'm trying to time this just right, get a 2.5%. The difference, and people are buying payments, they're not looking at the big picture. The difference in payment between a 2.5% and 3% interest, next to nothing. But yeah, you hit that 6%.
Yeah.
Absolutely, 5 or 6. All right, Kurt.
So what's happened and what do you see going forward? What changes to the portfolios have you and do you see making?
Yeah, so I see more of a move to, and if I look at our portfolios now, and we some of my parameters are we buying things with solid earnings, growing earnings too. Stay away from some of the junk. We are a little more growth oriented. We'll probably stick with the quality names, trim back on some of those that have maybe gotten a little ahead of themselves. Of course, the market's doing it for us. So the real trick is to look and say, okay, what's going to do best going forward? I think stocks with rising dividends will do well this year. If you're looking at, market returns, if I'm right, mid to high single digits, you're getting a couple % on a dividend. That really helps when you're getting 26, 30%, that 2 or 3% dividend isn't going to make much difference. But at 6, 7, 8, 9%, 2 or 3% dividend is going to do real well. We could spend an hour talking about different. If you look at the big dividend payers that are paying out a ton, the telecom companies, for example, they're not growing. They're paying out a huge dividend, but they're not growing. So I think the key is to look for companies that are growing and they're growing their dividends. So every quarter that's kind of where I see us going. More the quality, a little more of the value. It's, you have to be careful too. A lot of it's being in the right sectors. I look at our portfolios now, we're overweight healthcare. I see healthcare doing all right this year. I didn't list it up there. And healthcare is a funny one. I'm really going off on a tangent here. Is with healthcare, you have your drug companies. That's kind of a consumer staple. People need their medication. Biotech is more of technology too. And I think that technology, and we've seen this too, the biotech companies have gotten hurt, but your drug companies, your insurers have done all right. So I didn't give you real specifics there, but it's kind of the general direction I think we're headed. Yes?
I know people are concerned about interest rates, but isn't the market taking a hit because of what's going on in Ukraine? Doesn't that have the last week it's really fallen, and I would assume that Ukraine has a lot to do with this, I believe. So that's one question. The other question is Netflix taking a huge hit because people are not renewing?
No. They're taking a huge hit because their subscriber growth isn't as fast as it was in the past, but it's still growing. Yeah, don't get me wrong, I'm not anti-net. I don't own Netflix. I'm not anti-Netflix. And I think it's going to be around for a very long time, too. And personally, I think some of the sell-off's been overdone. But they're, still growing, very positive earnings. But it's not that they're losing subscribers. Back to your first comment, and we were talking about this a little bit earlier, I fully believe the press, mainstream media, whatever you want to call it, isn't attributing today's downturn to Ukraine. I think it very much is involved. One of the things to watch too is when there's times of turmoil in the market, watch government bonds. People, the flight to safety, they're worried about things. A couple weeks ago, interest rates were going up. Stock market was going down. Interest rates were going up. So people were not buying bonds. Over the last 3 or 4 days, interest rates, especially on the 10-year, have come down, meaning people are buying bonds. They're worried about geopolitical events, and I very much think that is driving the markets today. That's my opinion.
You see, we talked about the various sectors and how you feel in general about them. I was thinking specifically about international companies. And I may have missed it, but I didn't think there was a speculation on international companies as well as like a a large international fund or something like that, not necessarily specific stocks, but just the difference between US and non-US.
Certainly. Yeah, so if you look, international stocks are very reasonably priced compared to the US, speaking of valuations. So I do think there's a lot of predictions, analysts that think that foreign stocks will do well this year. They've really lagged the domestic markets for a long time, so it's time to flip-flop. There are some, we'll call it headwinds with the foreign, especially foreign developed, is most of the foreign developed, we're talking about Western Europe. They have some demographics issues to a certain extent. They're not growing as quickly as some other places. Some of their government, we've seen a lot of government stuff going on, more regulation that's pushing back on it too. But I think overall, given their prices, that I do think international's a great place to be. Some of these companies pay huge dividends too, and they're growing, and the companies are growing. When I look at a portfolio, I don't necessarily say, okay, this is a French company versus a U.S. company. You look at where the revenue is. Coca-Cola, U.S. company, they derive a good chunk of the revenue overseas.
More so than the US.
Yeah, and then conversely too, you look at like Royal Dutch Shell, which is an oil company, but there's Shell stations all over the place here. And so I think it's maybe more important to look at the sectors, and within the sector you can say, okay, would I rather buy Shell or Exxon today or whatever it might be. But back to your original question, I believe, and we'll see if it happens, I think the foreign markets are primed to do well over the next couple of years. Valley.
Similar question to what you had. What do you think would be, in your opinion, the number one factor that would make you optimistic for healthy portfolios in the new year?
Well, a couple things. One, stronger earnings growth. I see a bit of a slowdown. I think one of the things would be consumer confidence. I'm really worried about consumer confidence slowing down, especially as part of inflation. So a lot of these factors all are very much intertwined. So maybe it gets back to a slowdown. Some inflation's good. There's healthy inflation, 2 or 3%. You get up to the higher 6, 7, 8% where it's noticeable. You go to the store and you're like, man, this is expensive. I don't think I'm going to buy it. So if we see inflation come down, then I think we'll see consumer spending increase, which would probably push earnings up quite a bit. The other part of it too is I just think these valuations have gotten high, but we've seen such a big market pullback. Things are going to actually look cheap at some point, especially some of these good quality stocks, and we're going to look back in a few years and say, hey, I wish I bought that at this time. So there's my thoughts.
What percentage of the total GDP is the government spending?
I should know, and I don't. I want to say like 20% or so, 15. And then it's broken out. There's federal and state and local too, of course. But it's a real small. I shouldn't say it's real small. It's significant, but it's not as large as the consumer.
No, we'll say, assuming something like the Build Back Better plan goes through, does that percentage jump a lot? Or is an extra trillion going into spending over 10 years a small enough amount where it's not going to change that?
Well, and it really depends on what the government spending is for. So they did their infrastructure bill. There's the money multiplier. So the government's going to spend money to build roads and bridges. They're going to have to buy Caterpillar equipment. The government itself won't, they'll contract somebody. But then Caterpillar is going to use their equipment to go out and spend it. These people are going to make more money, so then they're going to go to Target and buy more goods. And the Target employees are going to do better and go out and spend it at the golf course. So there's kind of the multiplier effect. But the government spending has to actually go towards something constructive. If it's just a payment going out to individuals, there's nothing else there. The individuals can go spend their money and there's some multiplier, but not to the same extent that if it's being used to build something.
So the infrastructure bill would have a good multiplier, where something that strictly gives money to individuals wouldn't have the same power of the multiplier.
Correct. Back up a little bit, not to get too political, but the parts of the infrastructure bill that are actually going towards infrastructure,
Yeah,
not.
that's the secret. What percentage is that of that bill?
I mean, so there's parts, but it really depends on what the government spending is for. And don't get me wrong, I mean, the government payments during the time of the pandemic really had to happen. There were so many people out of work. It was needed to prop the economy up there for a while, but it can't go on forever. Had,
Yeah.
yeah, not has.
Speaking of out of work, with all the people that have left the job market in the past year, we're talking about 11 or 12 million. What kind of effect, I mean, these are that many people that aren't earning money. That's,
Well, yes and no. One of the things that is, it's interesting, if you look at the jobs, so the government, comes out with their job numbers every month. There's a lot of people now working in what they call the gig economy. So they're not counted in some of those numbers, but they're driving Ubers. Granted, they're not making as much as if they're a software engineer, but people are doing a lot of these side, or they're open their own business. So there are a lot of people in the workforce. If you look at the labor force participation rate, it's climbing. It's not quite to the level it was pre-pandemic, but it's still better than 60%. A lot of people are working that are of working age, and part of it too is the stock market's done so well. There's people that have retired that sooner than they probably anticipated to. And they could be working, but have chosen not to because they don't need to. All right.
that's why the unemployment rate could go down, even though the number of jobs goes down too. But there's that many less people looking for work.
Could be. If you look, the unemployment rate's very low. We're at 3.5% right now, while the number of job openings is at an all-time high. It's kind of strange. All right, any other questions before I cut you loose? I'm sure many of you want to get on with your day. Well, thank you very much. Greatly appreciate you all coming. If you do have questions, don't hesitate to let me know.